You've probably seen the headlines, right? A startup raises 5, 20, $100 million from a top VC firm. In fact, Foxtail, a direct-to-consumer brand, very recently raised 250 crore rupees, approximately $30 million in its Series C funding round. Sounds exciting, doesn't it? Feels like success. But don't you think that's really silly? Venture capital is the fuel, not the finish line. Rohit Sharma doesn't celebrate when he gets a drinks break in the middle of the match. He celebrates after he wins the match. Venture capital is just like the drinks that a cricketer gets so he can go out and actually win the match. Most founders have no idea how venture capital actually works. And if you're a founder, you need to understand what's going on behind the scenes. Because VCs, they are not just rich people writing big checks. They are running a business too. And their business is all about one thing: turning other people's money into a lot more money fast. So today I'm going to break it down for you. Super simple. No jargon, no fluff, just the real deal on how venture capital firms are structured and what they're really aiming for. Alright, so let's start from the top. A venture capital firm is usually made up of a small team of people. These are the general partners or the GPs. Think of them as the ones running the show. Now, where do they get their money from? They raise it from big institutions called limited partners or LPs. These could be university endowments, pension funds, family offices, basically rich people and organizations that want to invest in high risk, high reward stuff. Let's say a VC firm raises a $100 million fund. That means they now have $100 million to invest into startups over the next 9, 10, 12 years. But here's where it gets interesting. They don't just invest the money hoping that every startup does okay. Nope, the math doesn't work that way. They realize that most of those startups will fail, like completely. In fact, 90% of startups in India close down in 5 years, funding or not. Out of 20 companies they invest in, maybe one or two will be big hits. The rest, they'll either barely survive or shut down. So, what do VCs actually want? They want those 1 2 startups that grow like crazy, like 10x, 50x, even 100x returns. That's how they make their money back and turn a profit. Now, here's the kicker: VCs themselves don't really make money unless their fund makes money. They charge a small management fee, sure, but the big money comes from what's called the carry. Carry is basically their share of the profits after they've returned all the LP's money. So, if that $100 million funds turn into $400 million, they are supposed to guarantee a minimum hurdle rate, which might be approx $300 million over the next 10 years. So the VCs might get to keep 20% of the $100 million in profit. That's approx $20 million. So no exits, no big returns. They don't make much. So now you can see why they are constantly asking, how big can this get? Is this the next billion-dollar company? They're not trying to be mean. They are just doing the math. So, should you raise venture capital? Maybe. But here's what you have to ask yourself first. Do you want to build something huge, fast, and eventually sell it or go public? Because once you take that VC money, you're basically signing up for that ride. They are betting on a home run and they'll push you to swing for it. It's not evil, it's just the game. But it's your job to know the rules before you decide to play. So next time you hear someone say, we just raised $10 million, remember, they didn't get just money. They got a business partner or maybe even a new boss with a stopwatch. Know what you're building, know who you're building it with. Remember, venture capital is the fuel, not the finish line. And if you found this video helpful, check out the next video of mine in the left side of the screen. You will be learning more about how you can raise funds for your business, whether it's debt or equity, so that you are much more prepared to grow your business faster. All the best. Take care.